Okay, the real estate transfer tax is the tax imposed upon the buyer and seller. I think I left off just before that on revaluations. Correct? At least on the books that I saw open that were sitting on the desk.
Five.
Five.
Page 54, I believe, revaluation.
Let me catch it.
We held off the start of class for you.
Not really, I'm stumbling over what page. If the truth be known, Lena.
I was trying to make it sound good on your
Yeah.
part.
Yeah. So the real estate transfer tax, if you purchased real estate, you're probably familiar with that. It's a tax imposed upon the buyer and seller. It's $440 per thousand, .0044 per thousand, and it's split between the buyer and seller at $220 a thousand. I don't believe there are any questions on the test, so if you don't have any quick questions on the real estate transfer tax, we can move on. If you purchased real estate, you've paid it. Whether you read the closing statement close enough or not, I mean, you've paid it. Primary assessing areas, we've gone over that, and this is just the concept of regionalization, and whether it's a district or a unit, a single municipality, and we've gone over that. Lewiston was in that. Real estate taxes. All real property within the state is subject to taxation unless exempted by law. Real estate is assessed as of April 1st. We've gone over that. Highlighter on where and to whom real estate is taxable. Where is real estate taxable? Real estate is taxable in the municipality, typically where it lies. The assessor has no authority to assess a tax against property outside the municipality or the jurisdiction. To whom is real estate taxable? Real estate may be assessed either to the owner, person in possession, the mobile homes case that we were discussing, situation, and thereof. So 36,553. When real estate is assessed to the person in possession rather than the owner, the person assessed should be identified in the assessment records as tenant in possession or person in possession. Tax upon real estate, even if the person to whom it was assessed may have been only a tenant in possession. Assessment is legal. An assessment can also be made against tenant in possession of part of an entire parcel. Court has ruled, for example, that when a person built a cottage on a lot of land under a verbal permission of the landowner, that person became tenant in possession of both cottage and land, were rightfully assessed real estate to him as possession. If he's just on a leased piece of land, I would assess the land to the landowner. Bank, real estate, bankruptcy, bond for deed, also purchase sale agreement or land installment contract. This is a contract only. There's no transfer of ownership until the contract is fulfilled. You always assess the owner of the property until this contract is fulfilled, even if the person that owns the property says, no, they're responsible for taxes. You're responsible for the taxes. You can get the money from them. It's your land. buildings on leased land. The buildings on leased land and not owned by the owner of the building should be assessed to the owner of the building and the land to the owner of the land.
So you would use two separate tax cards at that point?
Yeah.
Okay.
Yeah. In the unorganized territory, I mean, there was thousands of leases which are slowly being sold. We assess the landowner for the land, even if it's waterfront lake, and we break it up into 100 lots, we'll say, and the owner of the land gets the tax bill for the land, and the owner of the camp receives the tax bill for the camp.
Okay.
There's the Condominium Act that defines 33, 10A, and 31, that defines condominiums in timeshares. And they can be a little tricky. Condominiums are more straightforward than timeshares. You won't see anything like this on your test, but timeshare estates and the interest thereof can be set up to tax one entity, the managing entity of the timeshare, if they request so, but they have to supply the names, because if you've ever worked in a town with timeshares, there's 52 weeks and they usually sell 50 weeks of the timeshares. So you got 50 owners for each room. And you could have 100 rooms or a couple hundred rooms, so it gets very convoluted. And plus, with the timeshare interest, they're purchasing the right to belong to resort swap or whatever it is. So there's some interest in that is not really real estate, but a lot of timeshares have gone to having a managing entity and one tax bill go to them, but you still have to keep a humongous spreadsheet, we'll say, to track all the owners and what week they own and what room they're in. Okay, undivided real estate of a deceased person or descendant may be assessed to the beneficiaries, generally without designating any of them by name. Undivided real estate is property held by two or more people with no specific percentage assigned of interest, such as joint tenants. Okay, if property is identified in a will, it must be assessed as to the devisees of the descendant, to each beneficiary, or to the personal representative. I skipped down a paragraph because this is not on your test. If the property is not described in a will, that property must be assessed to the heirs of the descendant, to each beneficiary, or to the personal representative. It's best not, never to, we can get in a long discussion of this, it's not on the test, but it's best not to assess real estate to the estate of the descendant, to the devisees. Avoid assessing to the heirs of or devisees of a descendant if possible. Try to find a personal representative or...
You don't ever do estate of. You should.
What?
You shouldn't do estate of. So we should not do estate
Yeah.
of.
It's always led to problems in my town.
Heirs of is better,
Yeah. Mm-hmm.
if you can't find somebody, but it's best to try to
Yeah.
find it.
If you can't find proof of a will, then heirs of always works.
Mhm.
But
What's,
and it's okay if you find out later there's a will, you can change it. But heirs of is your first default. Devisees if there's definitely a will. But never estate of.
Probably not pertinent, but what would be the difference in the estate of? To me, it's kind of like their estate is whatever their will says.
You just don't use it.
Okay.
Yeah, it's not valid. Never use estate of.
Even though there are towns that have without issues, but there's a court case. Former owner, 36,557. It is lawful for the assessor to continue assess real estate, as we spoke about, to the former owner if the new owner is not known. Forest land's not classified under current use tax law. This is not used in most towns, and very rarely that your excess land or undeveloped land rates take care of this assessment. Just value overrides this. This will not be on your test. Jointly owned property, a tenant in common, a joint tenant may be considered the sole owner for the purpose of taxation. Tenants in common means that each owner has a specific interest that can be sold and transferred independently. Very few properties are owned tenants in common, especially residential real estate. But that means you have a specific, like 50% interest in the property, and you could sell that to anyone who so desired. Joint tenants means all owners own the property together. Be like husband, wife, domestic partners, whatever. And if they're joint tenants, one passes on, the ownership is automatically seamless, it goes to the other party. Life tenant is not on your exam and can be a little bit confusing, but a person who acquires or retains a life estate in real property is considered the owner of that property for the purpose of taxation, and the property should be assessed to the life tenant. You gotta be very careful with deeds. Attorneys like for estate planning like to give the right to live there or the right to occupy the property. For the rest of it, it's transferred to their children or somebody else. They are not a life tenant. The life tenant actually owns that property until they expire. They could actually sell their interest in their lifetime to someone if they, it's not very marketable, but a life lease is not a life tenancy. But it's not on your test. It's very, very confusing, and even attorneys love to try to push the envelope a little bit and say, well, this is written up for estate purposes and this is to pass the property. I says, I know what it is. It's to avoid any main care or any other issues coming up. That's exactly what it is. I says, she does not have any bundle of rights, or he does not have any bundle of rights in that property. They passed them all to their children. So they are not a life estate or a life tenant. Manufactured homes, as defined in Title 10, 9002, except for stock and trade or inventory, are taxable as real estate. But campers are generally taxed as personal property. Mortgage property, in the cases of mortgaged real estate, the mortgage or the borrower, for the taxation purposes, is deemed the owner until the mortgagee, bank, or lending institution takes possession. When partial interests are transferred, one can assess the major owner, et al., all others, and for the entire property, or one can assess the individual ownership percentage at the request of the owners. There are multiple properties or land holdings that have multiple ownerships percentage. Usually there's a managing entity, which makes it a lot easier sending the tax bill. Railroad buildings, buildings of every railroad corporation or association, whether within or outside the located right-of-way, in any of the right-of-way that has been abandoned, are subject to taxation in the places in which they are located. Okay, resident, non-resident ownership. Historically, assessment records were separated into resident and non-resident section. The practice has facilitated the assessment of personal property and tax enforcement procedures. As no one, well, there are a few towns still left, I can't say no one, that have resident, non-resident books. It's just very few. But there's still some in practice.
Our last town clerk did that.
Standing wood, bark, or timber. Whenever an owner of real estate notifies the assessor that any part of the standing wood, the bark, and timber rights standing on the property has been sold by contract in writing and exhibits proper evidence, the assessor will assess such and to the purchaser and the land to the landowner. It's usually a 90-10 split, and that is done very, very, very rarely in today's world. It was more common about 20 or 30 years ago, but it's very rarely done now. Timeshares I touched on, won't be on the test. Trust property, the name of the trustee. Unknown owner, if you have some land that is not, it's not on the test, but an unknown owner, if you have pieces of land out there that you can't determine for previous 20 years, preceding 20 years, excuse me, there's a process to post it, and the town can take it by lien. It's been done. Description of real estate. You want to highlight that. Municipality by law giving a claim against each parcel of taxable real estate to secure the payment of the tax assessed against the real estate. The claim is called a lien. And it comes ahead of any other claim against the property except a claim from the federal government. Feds take precedence. This claim may be enforced in 3 ways. By action of debt with specific attachment, 36-941, a tax auction sale, sometimes called a tax deed method, by recording a lien certificate in the registry of deeds, sometimes called a tax lien mortgage method, 942. This lien is extremely valuable to the municipality within. Without it, it would be difficult and almost impossible to secure any real estate taxes. Okay, a third paragraph, if it's the same in your book, a careful and correct assessment requires that each parcel of real estate separately assessed, 36-708, each parcel of real estate be adequately described in the valuation book. An inadequate description will not invalidate the tax, but to protect the lien process, the assessor must impose a supplemental assessment to correct any description error. So, there are 3 methods of describing real estate for the valuation book. Do we know what those are? Map and lot, meets and bounds. A lot of clerks used to write out boarded by Smith, then 200 feet on the west or something, boarded by Jones, and to the back to the Smith farm or something like that, and they used to write all that out. Well, map and lot, meets and bounds, map and lot, and book and page. Map and lot being the cleanest, and the most descriptive and the easiest way. That will probably be just a little further on in the book, but those are 3 things to remember. Okay, separate assessments for different parcels. We could go on forever on this because there's no good parcel description in statute. And this is what basically the whole Scarborough case hinges on, a lot of this, but it will not be in the immediate future, so just know that there is a couple of court cases that deals with parcels and separate parcels. I mean, people can describe parcels in different ways. I mean, there may be a farm that's a 500-acre farm that may have been amassed through several parcels, but it's all contiguous. Why wouldn't you assess that as one parcel? So it could have been on 100 deeds. Unlikely, but if you go into the assessing profession, at some time you will find someone arguing the separate parcels or separate assessment for different parcels. And there's court cases that depends on what the basis of the plaintiffs was complaints. That there's a couple of cases that contradict each other, so subdivision interest. Complete and accurate description. There, I told you it was down here. This, you can highlight this portion again. I skipped down a few paragraphs, and you should have a heading. Bill doesn't like to bold things, I don't think, so a complete and accurate description. Those are the 3 we spoke about. Does everyone see that in their book? Are there any questions on that? Most people use the map and lot, and you'll also see book and page in there, but any liens filed on it in the commitment book, most liens are based on the map and lot description, because it's easy to lose track of if it's transfers a lot or to transpose numbers on the book and page, or get something wrong with that. But those are the 3 legal descriptions of property to secure a lien. If there's no questions, I'll move on, but I just want to point out that again and emphasize that that is in your near future. Current use assessments, we've touched on those. Later today, after we do the exercise of the quiz there, I'll go through a tree growth penalty. quick like, an easy tree growth penalty, but we all realize there's
We have,
four, what?
we have done a tree growth penalty.
Yeah. Yeah. Four classes of, there's four different categories of current use: tree growth, farmland, open space, and working waterfront. The penalties differ a little bit. Any questions on the test are pretty straightforward. Some of these can get very, very convoluted and complex, the penalties. I have spreadsheets that I usually, when I assist towns, that I usually develop for them so they can hand them off to the taxpayer, the bad news. For some people, there is always a penalty due, or the property is encumbered if they change the use. But it won't get into great details, the technical stuff about, they'll just ask you what the penalty is for if X number of acres came out, and they'll give you the values to work with. The minimum acreage for a tree growth classification would be 10 forested acres. That's the minimum amount of land. It has to be forested land. You can own 10.5 acres and have a quarter acre cleared for a camp and still comply with the tree growth tax law, as long as the other 10 were forested. But compliance with the forest management harvest plan is not in your future, but unless you're going to be assessing a immediate future, let's put it that way. There's a multiple step process for removing shoreline zones. If you have a tree growth question, just, tree growth is right in the back of the, yes.
So on one of the practice questions you handed out yesterday, so it was, I believe, who would, they were asking who would you, would be the next to appeal to if you were to remove their property from tree growth,
Yeah.
which I couldn't find anywhere.
State board.
State board?
Yeah.
Okay.
It's in there.
Okay.
It's buried in there, probably in the third paragraph under the state board. They handle current use appeals.
Okay.
They handle commercial property valued at $1 million plus appeals. And they handle state valuation appeals. If a municipality is agreed with the state valuation that my office sends out, you appeal to the State Board of Property Tax Review.
Okay.
Yeah.
But abatements go to the county after the municipality, correct? The county abatement?
Abatement appeals,
Yeah.
yes, unless it is a current use appeal,
Okay.
they have the right to go to the state board,
Otherwise, it's the county appeal?
yes.
Okay.
Unless the town has a local board of assessment review.
Okay.
Okay. If the town has adopted a local board of assessment review, it goes from the assessor to the local board of assessment review, and then if they're still aggrieved, they can go to Superior Court.
Okay.
If it's a current use or a non-residential property with $1 million, excess of $1 million or excess valuation, it goes to the assessor. It can go to the local board, but a lot of them appeal that to the, if they have a local board of review, a lot of them appeal that to the State Board of Property Tax Review. And then from there they go. Current use, same thing, assessor, they have the right to go on to the state board. the current use. Okay, whenever a withdrawal of land occurs, except through the exercise or threatened exercise of eminent domain, a sale to a municipality or an instrumentality of the state or federal government. Now, CMP is just widening well, they have been, but they're, power project where they put, updated all their lines and put in new lines. They actually have power of eminent domain. So when they were removing swaths of land from, that were classified under tree growth, there was no penalty because they could exercise their power of eminent domain because it was for the greater good.
So the state gave the power of eminent domain to the power
No.
line company?
No, PUC probably holds it, Public Utilities Commission,
Okay.
but it's, when they put power in, it's for the benefit of the greater good, so they have the threatened power, they didn't give it to them, they could have exercised that. but,
Okay.
you know, like the school district, they buy a swath of land to build a new school, they're exempt
From tree growth.
from the penalty, those, or federal government. Other than that, there's always a penalty due to whoever changes the use. And that can get quite complex and convoluted. Penalty amount is 30%. Goes on after 10 years to 20, it drops 8% in increment in 1% a year from year 11 to year 20, down to 20%. And the penalty is derived by the just value at time of withdrawal is governed by the assessed value of comparable property that is not valued on the current use basis, adjusted by the certified ratio. You probably want to highlight that. What is just value? It is your local assessments, not what it's sold for. If the property was, we'll say 5 acres removed from tree growth, and we'll say they, just for the sake of the example, the tree growth rate was $100 an acre, it was assessed for $500 under current use. If the just value of land, in this case, I'm gonna make it very simple, I'm not gonna get into base lots, so it's gonna be very rudimentary here. We'll say those 5 acres would have been valued at just value of $1,000 an acre. So that's $5,000. So you get $5,000 for the just value. Just for kicks, we'll say the town is at 50%. Must be pound. So what would be the 100% just value of those 5 acres? If they're assessed at $5,000 comparably through the town, they're assessing, their declared ratio is 50%. What would be the just value for the tree growth penalty of those 5 acres? I hope $10,000,
Yeah.
right?
I'm trying to figure out which way you wanted to take the number. You double it when it's at 50%.
Well, you divide it by 0.5 and it comes out
Right,
same as
right.
doubling, yeah.
Okay, yeah.
Yeah. I'm using 50% for my simple mind, that way I could have used 75%, I mean 70%, you know.
So then we go with then we go through and how many years has it been
You got
out?
$10,000, yeah, minus you've already adjusted for your declared ratio. The tree growth rates were the tree growth rates were $100 an acre. Whether the town adjusted them, most of them don't. Well, smaller towns, all your towns do, but most towns are at 100%, thank God. Those are things I don't have to deal with, close enough, as we did in the past a lot, but, so we got $10,000 just value, right? We got $500, so that leaves a difference of $9,500. We'll say it had been in there for 15 years. So what would the penalty be? If you have a difference of just value against tree growth value of $9,500, what would the penalty be? And it was in tree growth, it was classified as current use tree growth for 15 years. Hmm?
I lost you.
So it's 25% of the $9,500?
$9,500, yes.
$9,500.
Yeah, 25%. I was looking for a number, I
So
don't get it.
$2,275.
Yeah, that is the penalty.
$23.75.
Stop right there. If the example gives you the mill rate of the town, who cares? Okay?
And you only do it for this 1 year, you don't have to, don't you go back 10 years previous?
No.
Okay.
No, no.
Okay.
The penalty's always the greater of two. The 5 years back taxes, or the difference between the just value and the tree growth value. And I can
Okay.
tell you B, being the difference between the two, will be the dominant tax unless your land values are so ridiculously low, it shouldn't have been in tree. It probably wouldn't have been in tree growth anyway, current use classification. It did come up a lot in the past, because when tree growth was passed, a lot of the rural towns, especially north of Augusta in Penobscot and Aroostook County, Washington County, Piscataquis, I mean the whole umbrella part of the state, Somerset, their rates were lower than the tree growth rates. And it was mandatory for large parcels to be in tree growth. That's why the assessment standards were also there, to make sure that towns brought their assessments up.
Could you run through that again, how you got to that?
Yeah. The, I'll end up writing too much. The just value of 5 acres of land, 5 acres is $1,000 an acre. So that's, we'll go $5,000. The TG, or tree growth value of those 5 acres, I'm not gonna get breaking it down to species, softwood, mixedwood, and hardwood, is $100, is $100 per acre equals $500. This is the 100% value. Problem here that I'm making a little more complex is the town's certified ratio is 50%. These give off quite a, wow. If I hit the floor, you know why. The inhaler here that I've got in my hand. So you got $5,000 just value. This is how everyone else is assessed in the community. This community is only at 50% of market value. The town, the tree growth withdrawal penalty says just value adjusted by the certified ratio, what I had you highlight, correct?
Mm-hmm.
So this needs to be adjusted by the certified ratio. Depends on how you, these are the 100% tree growth rates described by the state. You may have assessed these at 50%, but in the example Friday, they're assuming these are the 100% rates. There will be a ratio thrown in there too.
But our just value, our assessed value, that's say 5,000 or, 1,000 per acre, if that's the community's just value, that's already adjusted by the certified ratio. That's
No.
what would have been.
No, if you're assessing at 50% of market value, that's what that 1,000 acres comes out. I mean, every acre in the town, if it goes on the markets, assuming this is an average, is selling for $2,000 an acre. Town's only assessing for $1,000 an acre. So it has to be adjusted up for the sake of the penalty.
Oh, adjusted up.
Yeah. By
If
simply
it was 100%.
You multiply it by 0.5.
Yeah.
You multiply it by the 50%.
divide it by 0.5.
Or divide it by 0.5, excuse
So
me.
you're saying it would be 2,000 or 10,000?
Yeah.
Yes, it's 10,000. And then you
Be
subtract
10,000.
the 5 from it to get 95, and then you take your 25% of that from the chart that they're giving you here,
Yeah.
and that's your penalty.
If it was at
There will be something to this in your future, so this divided by 0.5 equals $10,000. So this is your just value at 100%, and that's what the law says. Your local adjusted value adjusted by your declared certified ratio. I don't know if it uses the word certified or,
certified assessment ratio.
adjusted by the certified assessment ratio, so. Hopefully everyone found that in their book and highlighted it, okay? So this is the value at 100%. These are the tree growth values prescribed by the state tax assessor every year, or that will be in your example or something similar. So it's 10,000 minus the 500 gives you a difference of $9,500. This is the difference. Everyone get this far? And then I said it was classified for 15 years. So the percentage drops an increment of 1% a year after 10 years. The 11th year it's 19, so it came out at, not 19, 29, excuse me. It came out at 25%, correct? Okay. Oh. Percentage is 0.25. And that is $2,375 is the penalty for that. Stop right there. If the example happens to throw in the town's mill rate, ignore it. Okay? I don't know how devious they got with the question. No. So, there's further penalties if the landowners didn't declare that they were changing the use. Some towns, you can waive that if you want, but some towns go, this guy's been a real problem in town. I'm gonna put the additional 25% on there, but that is not on your test.
If the tree growth rate was 500 per acre and they were certified at 50%, then theoretically,
You would have to price the 500 acres altogether. This would still be divided by 50 if they were at 50%. Whatever the result was, this is the town's unit price, their just value.
no, what I'm trying to ask is about the tree growth price. So if the tree growth rate in the state this year is 500,
Yeah,
and I have a parcel that's in tree growth,
yeah.
am I assessing that parcel at 500, or am I assessing that as a portion of that due to my certified ratio?
If it's in tree growth and you're at 50%, the rate is 500 per acre. you should be assessing at $250 an acre for that. So this would also have to be adjusted in your example. This, I wrote down as the 100% rates of tree growth. I should have put 100% here, but this in the example will be given to you. And the assumption is that this is the tree growth rate. Don't be adjusting that.
We're saying that's what they were being assessed for last year.
Yeah, well,
The rate that they were assessed
but
at.
they're gonna, the problem is the town will be at a lower ratio than 100% in the example, I'm pretty sure. But the example goes on, I'm pretty sure, I'm gonna look at it again, and I've instructed the person that corrects these that either way is correct, because the example is not clear in the book, unfortunately. But
But in the
Typical.
real world, if the tree growth rate's 500 and we have a ratio, we need to adjust that 500 by the
Correct.
ratio to assess
Yes.
them. And
for
this
just value
difference-
assessing, why are you gonna assess?
Exactly.
Yeah,
And when we're calculating penalties, we should be using what they were actually assessed, which is the tree growth rate adjusted already.
Right, because it's
I-
current use.
Right.
Yeah, because of its current use status. It
Yeah,
doesn't go
I've
up
got
with a certified
spreadsheets
ratio
that-
too.
that would have adjusted this, I would have put in the local tree growth rate, I'd say local tree growth rate, but right here, I said it was 100% of the tree growth rates. I skipped the process. I would have adjusted this if it was a local rate less than that. It depends on how you set the spreadsheet up. I mean, if you're assessing them at 50 cents, that's gotta be at 50, that's gotta be adjusted also to the tree growth rate. It says the difference between the just value and the tree growth rate would be the penalty. Disagree?
I was gonna write it, I was gonna use your, I feel like we're lost a little bit.
What?
Are we lost?
I think I understand, but I feel like I'm hearing it slightly differently than what I.
I'm trying to break it down into one of those nice formulas you gave us before, and it's difficult.
We'll use the same numbers.
I have 4,000 spreadsheets here that have helped towns.
Yeah, I just wanna write it down.
Yeah.
I'll do the same numbers. Just value is 5,000.
The assessed value.
Yeah, like 1,000 per acre, 5 acres.
And then the tree growth value was 500%. The town was actually
There we go.
at 250. Right.
And we're doing our 50% on that.
Right.
That is.
Right.
50%.
So 5,000 divided by 0.5 equals 10. 250 times 5 is 1,250. 1,250, right?
Mhm.
Divided by 0.5 is 2,500.
Well, that's already adjusted by it, right? Because it's 250 instead of that.
Right, so the town's using 250, so you have to adjust the town by its 50% certified ratio that they're actually using for tree growth. So the state tree growth rate is 500, but the town's using 250. My point is you need to adjust your assessed value and the tree growth rate value you're using, because it should be adjusted down if you're at 50%. Or am I making this worse?
Making it worse.
I think you
as far as
made it
I'm
worse.
concerned.
I think
It's
you said
pretty
that.
straightforward.
I'm okay with that.
Okay, this was the just value. The town's just value. The town is assessing. This is almost like the question you're gonna have, okay? Not quite, but
Because I guess what she was trying to ask specifically is in this example, the tree growth has already been We haven't done it, but it's already been modified by the certified ratio.
I
This
put
you're
in,
trying to show us that how it's modified by certified ratio, it's just the numbers aren't quite lining up, I think. Yeah.
okay,
Okay, when you're doubling you're already fixing that.
Yes.
Yeah, you're already fixing it when you're doubling it, timing it by your certified ratio, you're already fixing your tree growth value.
yeah.
Right.
So you don't have to.
You always divide it by the certified ratio.
Right.
Always divide by the certified ratio.
Because if you were at 110%, this would be brought down. Yeah.
So if a town's got a just value that's at 50%, but they're assessing tree growth at full value, they're not doing it correctly.
Right.
I'm not saying they were assessing tree growth
Don't
at full
say that.
value.
That's
What I'm
not
saying
right.
is I put the full value in there,
Yeah.
which the law tells
Then
you
you
to.
didn't adjust by it.
Yeah. I don't need to adjust by it, because that is the full value.
Right, he put it in
That's
his
tree
full
growth,
value.
yeah.
Based on full value
Yeah.
or?
I think we're ending up at the same crossroads.
You ended up at the same intersection.
What you're telling me is I need to go sit down.
These are spreadsheets I did for towns, and I mean, I explained my work, but it's got multiple acres and it's much more. Thank God the town's ratio was at 100%, so what I did is I calculated everything else. They have a graduated sliding scale for acreage, so I priced their acreage out. They happen to be in Vision. I got the Vision chart out of the computer for the number of acres. I actually priced out the other stuff, came up with a difference, penalty, the same. It's just, I'm giving you the basic question that you're gonna be facing, and I'm also telling you that if they happen to ramble on in the question, and I can't remember if they do, I knew they did at one time, but if they happen to ramble on in the question and give you a mill rate of 7, we're gonna ignore it. The penalty's the penalty. It's not computed by using the mill rate. The penalty is computed by using the section of law that we were just in. What is the description of just value? And we've gone over it, 100,
Well,
whatever percentage
your
of.
just value for the acreage that's being
Yeah,
removed.
whatever percentage of the majority of the other property is.
So would that be better to call it market value instead?
No, that's fine the way it is. I mean, it's all depends on how your thought process, there's 3 learning, no. Some people are intellects, they take that, they run with it. Some people are doers, and they have to calculate it out.
This paragraph that you had us highlight says that the just value, which is our assessed value, needs to be adjusted by the certified ratio to get our
Correct.
just value. So that's what he's done here. That's why he's using the just value
Well,
there,
okay.
because it's the assessed value adjusted by the certified ratio.
You go back to
You're
that
using the word just
paragraph.
value in this paragraph.
Just value at the time of withdrawal is governed by the assessed value of comparable property. That was the $5,000 an acre. That is just value. No matter how you look at it, that is
Okay.
what comparable property is assessed at. I don't want to make it too complex so to confuse
That
anybody.
is comma.
Just value. You want- Okay, just value at time of withdrawal is governed by the assessed value of comparable property that is not valued on a current use basis in the municipality. Adjusted by the certified assessment ratio, so. Go back to the just value description. You can look at it either way, but you need to arrive at what the property would be divided by the certified ratio. That formula works for you, please put it down, as long as you come at the same result. Either way. So we all set on that? We know to just ignore any mill rate or tax rate that they may add in for you. Farm, land, and open space. Okay, we've discussed that. There may be an example of that, and I'll catch that on the review. If there is, they'll ask you probably to price out farmland, and they'll give you the unit per acres value, and they're gonna ask you, I don't believe you're gonna see a farmland penalty in your future. I know you're not gonna, because they're more convoluted and complex because it's 5-year back taxes. And I have a spreadsheet for that with simple interest. So I know that is not on your test because it would take you most of the day, or most of the 4 hours allotted to do the thing properly. So they'll ask you to price farmland probably, but they're gonna give you all the information you need. What the farm base lot is, and the number of acres, and the unit per acre that it should be assessed. They're gonna ask you to come up with the assessment on farmland. The penalty in farmland is less punitive than the penalty in tree growth in open space. It's five, the difference between the taxes that would have been paid at just value, less the amount that was actually paid in that year, calendar year for the 5 preceding years of withdrawal, is how you calculate a tree growth penalty. If you ever come across one and need a cheat sheet or something, I can forward you an Excel spreadsheet in minutes that you can calculate it with, and you just have to put in pertinent information with the municipality and the year and so forth. They even will calculate the simple interest for you. Time, okay. There's the 5-year penalty for okay, we won't get into legal limitations of land use, but it does impact the value. You read what just value is, it's to take in every consideration. There will be nothing on that on the test. Zoning, of course, you just need to know environmental protections, housing codes, and so forth. Easements impact the value. Conservation easements may limit the highest and best use of the property. The number of structures that could decrease, doesn't always, it may increase. Okay, telecommunications excise tax, you don't need that. Personal property taxes. There will be some questions in your future. All personal property owned by inhabitants of the state of Maine, except that exempted by law, is subject to taxation. Personal property of non-residents of the state, with certain exemptions, is also subject to taxation when it is located in the state on April 1st. 36602. The assessment date is the same as real estate, April 1st, section 502 and 708 in Title 36. Personal property defined. Personal property for the purposes of taxation includes all tangible goods, 36601. Excise tax on watercraft is imposed in lieu of property tax. property taxes on watercraft. So there are no questions on the excise tax on the watercraft on the test, to my knowledge. I will verify that. I'm sure there isn't. Municipalities may not tax personal property permanently located and legally taxed outside the state of Maine. Individually owned personal property with a just value of less than $1,000 is exempt from tax, except property used for business and vehicles not registered for use on public roads under the Chapter 111. Okay, where and to whom is personal property taxable? The general rule is all personal property in Maine or temporarily out of the state is assessed to the owner where the owner resides on April 1st. That's 502, 602, and 708. There are exceptions to it, and there are exceptions on the test. Personal property is taxed in this manner to prevent certain kinds of property held and managed at a location other than the owner's residence from escaping taxation. This general rule is subject to a number of exceptions that are noted below. Although all personal property is generally taxable by the owner's municipality of residence, including, for example, such items as unexcised motor vehicles and farm tractors, there are exceptions in statute, including specific exemption for persons or corporations residing outside the state. That's 36603. There are only exceptions to the general rule found in 602. Okay, all personal property employed in trade, in the erection of buildings, vessels, or in mechanical arts shall be taxed in the place where so employed, except as otherwise provided in this subsection, provided that the owner, his or her servant, these laws were written quite a while ago, subcontractor or agent occupies any store, storehouse, shop, mill, wharf, landing place for the purpose of such employment. If I have a major contractor that lives in my town and his business is located in the neighboring town with a shop, all his equipment's there, and it usually returns there for maintenance or on a nightly basis when it's not out on a job, where is that personal property taxed?
The other town.
Correct. Yeah, the town where the shop or business is. That's where it's normally located, and that's where they conduct their business. But it's my property. You don't tax personal property in my town. I want it taxed here. It's done all the time.
Sounds like, for example, we got in my town, the guy's a carpenter, had a trailer, he drags all his equipment in, and April 1st, he's always sure that it's in another town.
Well, show me what town you pay taxes to, otherwise it's where you live. You live in your town.
He doesn't have a shop, he doesn't run out of business, he runs out of his house.
Pretty much, yeah.
So that is taxable in the town he lives in. The only exception is if he owns a building where he normally conducts business in another town, or another jurisdiction, we'll say. It will be taxable where that business is conducted. Moving it out of town on April 1st, nothing to do with it. Absolutely nothing.
We had a guy that actually had been told by the code officer that he was not allowed to keep his equipment at his house because of zoning. And so he was trying to say, you can't tax me on it because I can't keep it at my house. I keep it here, there, and everywhere from job site to job site to job site. I said, so it was like, unless you can show us that it's located at another location permanently or routinely as your primary location, show me that town that assesses it, I'll confirm with them, and then you're good. Otherwise, it needs to be assessed to your residence.
Correct.
regardless of where you keep it.
However, if he had a little garage or building in another town that didn't do that, then he could store it there and be
That
legit.
town would have to be assessable.
As long as he's operating a business out of a storefront or something, but if he's just storing it in the garage, but if that's where it normally returns for maintenance and all that, yes, it would be taxable in another town.
You can't just not get taxed on it.
Yeah.
Anyway.
Hey, how's it going?
Good, just in the Jeff.
What?
I was just looking for Jeff.
Oh, okay. You wanna come in and do the income approach? No, he ran. This includes, these laws were written quite a while ago, so this includes liquefied petroleum gas installations and industrial medical gas installations. They're taxable where their depot is. If they have a maintenance, like Suburban Gas, they deliver propane gas, and they own all the tanks that are attached to the houses, or that supply the houses. Those tanks are taxable where their shop is or where their depot is, basically where they return. These dumpsters that are all over the place that Waste Management comes and picks up, you don't need to be picking up every one of those dumpsters out of business. They're taxable in where their main shop is, even though they probably pick them up, dump them by the truck, and put it right back to where it was sitting, but that's taxable. These laws were written a number of years ago, so, you know, trash pickup and dumpsters was not available at the time. Unless you had somebody with a backhoe and a dump truck. They just threw it all in the dump truck and put it in the landfill.
The new one I have that cropped up this year was storage pods.
Oh, yes.
White storage pods are now located in some of my towns, but the business is somewhere else.
Yeah.
Something else to worry
And
about.
temporary structures for storage or moving or something, and hopefully, I'm not gonna get into temporary, those canopy vinyl things, and they're like the old satellite dishes and the above-ground pools. Ugh. Don't go there. Tax them to the business. They belong to the business and they routinely return there. Once they're off, they're not leased. Okay, cargo trailers are taxed in the place where they're primarily located. Primarily located has been deemed to mean the place where the cargo trailer is usually based and where it regularly returns for repairs, supplies, activities related to its use. The following items of personal property are taxed in the place where situated on April 1st. Portable mills. The quickest way for a portable mill, for me to describe a portable mill, is, it's not Blue Rock anymore, it's Lane Corporation, I think. Are they the ones out of New Hampshire?
Lane?
No, they're out of the seacoast. Who's the pavers, the major pavers?
Across
that-
the street up here.
Yeah. Anyway, they're, sometimes they set up, if they're doing a project, we'll say, away from that, they set up an asphalt batch plant and some screening plants and all. Those are portable mills. They produce something from raw materials. Bituminous tar there, the asphalt. Those are portable mills. So if you have one situated in a gravel pit on April 1st in your town, even though Lane Corporation is based out of New Hampshire, it is taxed in your town. Even though they may have a base of operation in Sydney, Maine, we'll say, which I think they do. All store fixtures, office furniture, furnishings, fixtures, and equipment are taxed where located. Professional libraries, apparatus, implements, supplies, coin-operated vending and amusement machines, lottery machines. They're taxable where located. Coca-Cola machines or vending machines, where located.
Can I ask a question on that? We have a lot of companies who have vending machines, but they're leased out by the vending company.
Yeah,
But then after a certain time frame, they fall off the vending company's list because they've then sold it to the business.
mhm,
Right. But it's like they fall off,
yeah,
and we don't know if the business has purchased it or if the company took it back and gave it to another customer. And I've had a lot of trouble with calling the company, and they're like, well, we don't know the answer, we don't have it there anymore.
yeah.
So how do people handle that?
You have to discover, you have to go out and physically,
Yeah.
I mean, if it's worth the time to go out and chase a vending machine, which,
Right.
you know, in a business, I mean, is it viable to do that?
Sometimes I'll just add it
Fiscally
to the
viable?
company
I mean-
and I can send them the tax card with a list. This is what we have, let us know if there's any problems.
Yeah.
Let us know by Friday if there's any problems. And that way, if they don't, then it's on that list. And
We give them a chance to.
Yeah.
To say something.
rather than saying, oh, we think you might have bought, you know, the vending company is saying it was a lease to purchase, we don't have it. And I just add it.
Yeah, so it's a,
And then,
it's a brand new $300 Keurig, high-end, and in a 4-year lease, now it just became the property of the business. What's it really worth, and how much time do you want to put into it?
Right.
So,
But there are
I cross them
bigger
all.
ones, too.
Yeah.
Well, they do a lot of lease to purchase on bigger equipment too, like a lot of the big copy machines that are 10,
Yeah.
12 grand.
Mhm.
A lot of those are lease to purchase,
Might be different.
yeah.
Yeah.
Keurig machine, yeah.
Computer equipment, they have a 3 to 5 year
Well, that-
life.
You're right,
Yeah.
but those copiers and stuff are,
Oh, yeah.
those have a longer life.
Yeah.
than-
They also have a hard drive inside them.
I do all electronics on a 3-year. I start at 90 and then it goes down to wherever the town has decided. But I do all electronics on a 3-year. It's scrap iron, scrap metal when it's done, so. Technology's moving too quickly.
And obsolescence.
Okay, so I'm gonna go back up here. My mouse is running across the following items of personal property are taxed in the place where they're situated on April 1st. Gonna go down to E, all camp trailers as defined in section 1481-603. That's where the authority comes in with taxing local Maine resident campers that are located in another town, and they come in with I pay the excise tax in the town I live in, so I should be exempt from property tax in this town, and most towns will buy that, yeah. No,
In Maine.
no. You were here year-round. You were here on April 1st. Your camper trailer is taxed here. If you want to excise it here, fine. I've actually had a couple of clerks refund the money to the town begrudgingly, but they did. So the person could prove that he paid the excise tax. He took that money and credited it towards the town where that camper trailer was. Camper trailers can be a huge headache. It's always good to get on the good side, public relations with the campground owner, or some of them cooperate, some of them don't. Television and transmitting equipment is taxed where it's located. Personal property of non-residents is taxed in the place where it is employed, either to the owner or to the person having the same in possession, or to the person owning or occupying any store. So if you don't know the person that owns it, it can be taxed to the person in possession. 5, persons under guardianship. Personal property belonging to minors under guardianship is taxed to the guardian where the guardian resides. You want to highlight that. Okay, so personal property belonging to minors under guardianship is taxed to the guardian in the place where a guardian resides. Personal property of all other persons under guardianship is taxed to the guardian in the place where the ward resides. So your highlighter should continue on the whole section, and you should recognize the distinction between the two. Personal property of owned by unknown persons, if taxed to the person having the same in possession. Certain corporations, mining, smelting, agricultural stock raising corporations organized for the purpose of buying and selling, leasing real estate shall be taxed to the corporation of the person having the same in possession. Deceased persons that won't be partners in business, it's all the same as, basically the same as real estate. Religious societies, who goes there? The test doesn't. Personal property brought into Maine after April 1st. Personal property brought into the state after April 1st and prior to December 31st by any person upon whom no personal property tax has been assessed is taxed as other personal property in the town in which it is first time in the state. 611. There are attorneys that will argue that this is unconstitutional if they paid a tax in another community. This came about back when 295 in the late 70s, early 80s, whenever 295 was extended from Brunswick to Augusta. If you're old enough to remember, it was formerly all concrete, which has been resurfaced. Just boom, 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 boom. Pretty smooth. It was referred to as the legislature's highway because a couple of legislators were caught driving it before it had fully opened, but they knew it was ready to drive. They just hadn't had all the signs up and the seating done and all that. It was a great drive at midnight when I was coming home from Wells, or coming to work from Wells, leaving Wells on Sunday evening. A great drive. Just it was a lot less populated back then than it is now, especially when it wasn't open. The contract was awarded for that major road reconstruction to an out-of-state firm. And of course, they started as soon as the frost was out of the ground. But Crocker down in Brunswick, big contractor, said they're evading tax. That's why their contract they proposed was less than, so this law was put into place. It's been used then by the company that, and it has been used for a couple of mining companies that brought in large equipment for mining purposes in Franklin County when they were looking and drilling for the validity of copper in Franklin County, north of Eustis area. But other than that, it's been rarely used. I think the assessor in China may have, past assessor in China, may have taxed Hannaford Corporation for their new Hannaford store, or attempted to. I didn't follow how that, I know he called and wanted to invoke that, but I said, be careful, because the attorneys think that is very unconstitutional.
I'm not sure that so this is, say they brought in stuff in May.
Yeah.
It's saying that if we haven't committed yet, we can still tax them even though it wasn't there April 1st?
That's what it's saying. It says up to December 31st, doesn't it?
Yeah.
Yeah. Yeah.
Just never thought that there was any exception to the April 1st thing.
Right. There is one exception. Attorneys may take serious exception to it. And if it's the next people's attorneys, and they've got deep pockets like that, I'd probably avoid it.
Yeah.
Yeah. But it has been used successfully.
It's just the first time it comes into the state from out of state.
Yeah, it hasn't been struck down by the law court, so,
They didn't pay anything on April 1st to another town, so
Right.
yeah,
There was-
in the state of Maine, and, but
I mean.
the genesis for that whole law was the 295 construction or expansion.
What
They have a
decade
good
was that?
argument.
Yeah,
What decade was that?
pardon me?
What decade was that?
70s? 80s?
Just trying to think, yeah.
I don't think you would recall it, right?
No.
It still hurts.
At least I'm still perceptive enough to come up with that. Description of personal property. It's always very vague, and if you want to lean it, get the UCC numbers, which Uniform Code, you can get those from the Secretary of State. If it's mortgaged, real estate, personal property, which in a lot of cases, large corporations mortgage their personal property, and that would be at the Secretary of State's office. Other than that, a good description, or as much description as you can put in there. Most towns keep very brief descriptions. There is nothing in your future, immediate future, excuse me. I've got to keep saying immediate future.
And even though mobile homes are not personal property for taxation purposes, kind of a good idea to pull the serial numbers off it, off the HUD plate when you're doing those inspections. It saves you a lot of time, and they eventually will move it. And
If you can get close enough by the dog.
small dog.
Small dogs.
Check the chain wrap. Where's the arc of the chain?
let's carry a stake in with you.
Okay, this goes on to explain the mortgage, personal property, and so forth. Better. Don't believe there's any questions on better. Better is the reimbursement program, not to be confused with Betty, which is the business equipment tax exemption, which is one of the reimbursable exemptions. We could spend hours on the better and Betty, which my advice, if you have any questions in the future, 1-800-CALL-JOE.
That's right. Joe Sally.
Joe Sally, I'm referring to, not Joe Bordstein. Okay. Okay, we've already discussed municipalities, who has the power of taxation, and why municipalities can't create exemptions and all that. That's listing exempt real property. Exempt real property should be listed as such in the valuation book, separately from the certification of the list of taxable property. Assessors are required to include the value exempt real property in their inventory of property at least every 5 years. In years past, valuation books, when they were handwritten, most towns would put the exempt property in the back, the fully exempt property, town property and all that. Some towns actually list it in their regular commitment book, town of such and such, or town of, but most do not list it simply because they don't want a tax bill. We've gone into that, the contractors mailing out tax bills to themselves. So, but it is required by law to be. And as of course, common sense, if this is done annually, is relatively easy to record any change of use in ownership that may result as the return of real estate to taxable status, which happens rarely sometimes, but it does happen. Public property of the U.S. government, you know, Uncle Sam is tax exempt without question. State of Maine, Maine Turnpike Authority, Finance Authority of Maine, New Hampshire, real property owned by a water division of New Hampshire Department of Environmental Services and used for the preservation of the recreational facilities in Maine is exempt from taxation. I think there may be a dam on the border someplace that this pertains to, down in Alfred, not Alfred, Acton, Great East Lake or something. But other than that, that's the only reason that law was written. Public municipal corporations, of course, are exempt. Water and sewer, municipal water and sewer. Exemptions, as don't believe it delves into exemptions of charitable and benevolent institutions, and this could take days, and we could debate the validity of all these, especially the land sanctuaries and so forth. But it's best literary and scientific. I will confirm if there's any questions on benevolent and charitable institutions, but I believe there is not, because it does get ambiguous at times. Chamber of Commerce, veterans organizations, Chamber of Commerce, religious societies, fraternal organizations. These are all exempt properties. What's the most recent one? Land trust? Not land trust, but yeah, land trust, I guess you would call it, yeah. They prevailed in court.
We found the right judge.
What?
We found the right judge.
Yeah.
If you look up charitable, it says benevolent. If you look up benevolent, it says charitable, so it's no help at all.
Yeah. Yeah, that's, found the right judge in southern Maine, and then it went on, but it really depends on how they're incorporated, their use of the property, and whether they actually are charitable and benevolent. But land trust is a, okay. Homestead exemption, it's one of the reimbursable exemptions. There may be an example or a question on the test to calculate a homestead exemption, possibly, or the value of it. All the pertinent information will be given to you. Reverend George Lambert versus Wentworth was the case I was talking about in Wells. Wentworth was the chief assessor of the Board of Assessors in Wells at the time. That was the veterans exemption for the non-residents. That was the case that tripped the unconstitutionality of the making non-residents that entered service, veterans who entered the service as non-residents of the state of Maine, 10 years residency requirement before they were entitled. Paraplegic, parents of veterans.
I have a question going back to the veterans. Veteran may claim only one exemption, but if there's a husband and wife or qualifying veterans, both are entitled to the exemption. So it becomes, the veteran's exemption doubles on that property.
Yes.
Correct.
Okay.
If they're both veterans, but
If they're both veterans.
they're only entitled to one. If one passes away, we'll say, comes a widower,
Mhm.
not entitled.
Right.
Widow, widow.
Because you can't be widow and a veteran at the same
Veterans,
time.
yes.
Got it.
So, just to clarify, you're saying that husband and wife, both veterans,
Mm-hmm, both qualify.
for the exemption, so they're joint ownership on the property.
Mm-hmm.
You double the exemption.
Yes.
Yes.
They're
One
each
property.
entitled to their own
If they
veterans
both
exemption.
apply.
If they
Yeah.
both apply.
Each get their own veterans exemption, but one person is not entitled to two exemptions.
If they're a widow and a
So if one of
veteran.
them dies, it drops down.
Right.
Yeah. If they're both veterans and both their names are on the deed, some cases they're both veterans, and a lot of times only one name is on
Okay.
the deed. It may be a second marriage or something like that, and they just happen to both be veterans.
Or we had a couple that the gentleman was a veteran and he was losing his cognitive reasoning.
Yeah.
And for their planning, they decided to take him off of the deed. Then they rewrote the deed into only her name. No longer eligible. Until he
Mhm.
passes away, then she'll be eligible for the veterans, but right, they've lost it for
Mhm.
gap years in between now and
They
then.
have, he has no estate.
He doesn't own it anymore. He
Yeah.
lives there, it's his wife, but it's not,
But if he owns another parcel in town,
yeah,
Yeah.
he doesn't. We did, we did look into that for him.
Yeah.
you don't have to live on the parcel.
Yes,
A little fluke of nature, not on the side. It's pretty
correct.
clear.
That is not on the test, by the way.
It's kind of odd,
Guardianship may be,
I've
but
had one,
yeah.
25 years, I've only had one that I can do it.
children, the federally recognized war periods. One of them's open-ended. These are in Bulletin 7. Okay, blind persons' estates. Okay. Other miscellaneous exemptions. Animal waste storage facilities. Are exempt, and actually, it's a reimbursable exemption. Exempt personal property. This camper trailers are exempt from personal property tax if excised paid prior to the property tax commitment. All you gotta do is make sure that it's paid in the, if it's located in another town, that it's paid in the town that it's located in.
It has to be paid in Maine.
Yeah.
too, right?
And technically, the excise tax is a precursor to paying, getting the registration. You cannot register a mobile home in the, a camper trailer in the town you don't live in. You can pay the excise tax, they'll probably gladly take it, but you can't get a registration plate because it would have to be on your residence. Farm machinery exclusively in the production, used exclusively in the production of hay and field crops.
Excluding motor vehicles, only on the, like, non-motorized stuff.
Non-motorized
So
stuff
it's just
with
the
an
trailers, not
aggregate
the
value of
tractors.
$10,000. So, I mean, if anyone knows what haying equipment costs,
So it's not a
the
$10,000.
grease fittings, the zerk fittings on those things adds up to more than $10,000 in the wheels.
It's not a deduction, it's up to $10,000 is
Yeah.
the exemption.
Yeah,
But that's just
Yeah.
the trailers and stuff, that's not the tractors that pull them.
correct. Non-motorized.
It affects the Amish in my town,
Excluding-
none of their stuff is motorized and all worth less than 10,000.
So it
Yeah.
doesn't seem like it'd be worth very much.
Yeah.
it's owned by a business, it might be Betty.
Yeah.
Yep.
Yeah.
For some reason, I think that's on one of the tests. I'm not sure whether it's one tomorrow or the one at the end of the basic course. Okay, furniture, household furniture, including televisions, musical instruments, farming utensils, clothing, mechanical tools is exempt. Tools do not include heavy and complicated machinery. Household items are exempt. Inventory tax has been deleted for years. Industrial, including raw goods, goods in process, and tangibles are exempt. Livestock. Registered snowmobiles are exempt from taxation. Any non-registered snowmobile valued at $1,000 or more is subject to a personal property assessment.
None of mine are assessable than $1,000 are valued.
Who's gonna go chasing snowmobiles or ATVs, for a matter of fact? It doesn't refer to it, but that'd be like chasing tractors. I could get into a long story about tractors and losing your job as the municipal assessor. Okay, vessels, individually owned personal property with items less than. Okay, snow grooming equipment registered under Title 12, Section 113. It's snow grooming equipment that's usually club-owned. It's also reimbursable. I will.
Would that be the same for like the big machines on Sugarloaf, even if it's business owned, that
No.
it's still exempt?
No, they're not registered under Title 12, Section 113.
Oh,
We can-
registered, okay,
Yeah.
gotcha.
No. That equipment is, most of it's leased, and a lot of it's leased and is taxable. And with current opinions, it's also eligible for Betty. Okay, property that is subject to excise tax in lieu of property tax is aircraft, boats or watercraft, mining equipment, motor vehicles, and railroad companies, telecommunication equipment. Supplemental assessments. Why don't we take a break and we'll get into supplemental assessments, because there are questions on the near future on supplementals. Supplemental assessments, Chapter 9. Chapter 9. I think this is pretty much the last chapter.
Abatements.
What?
Abatements.
There's 12 chapters.
Is it?
Yes, sir.
Well, what am I missing here then?
11, 10, 11, 12.
Miscellaneous special assessments, I can tell you we're gonna skip it. Chapter 11, we'll probably go over quickly. Abatements, definitely. Okay, so I got ahead of myself. Whenever the assessors determine taxable real or personal property has been omitted from an assessment, or that the assessed tax is invalid or void because of some illegality, error, or irregularity in assessment, then a supplemental assessment should be made, provided that it is issued within 3 years from the last assessment date, 36/7/13. The term invalid is defined in Black's Law Dictionary is not legally binding, while void means something that is of no legal effect. Omitted a supplemental assessment for omitted property is appropriate only when it is clear that the property had not been previously assessed. If you simply have a land assessment of proper land assessment, but you have a building assessment describing just buildings and a value of $10,000, and it was meant to be a $100,000 house, you cannot supplement the difference because you have a legal assessment. You have an underassessment, but the town just has to swallow that as an underassessment for that year and correct it going forward. Okay, supplemental assessments cannot be used when the assessor has misjudged the quantity, quality, or value of the property assessed, which was just an example I gave you. Supplemental assessments cannot be used to correct erroneous judgment and value. Which is the specific example I gave you. The supplemental assessment for omitted property is justified if the assessor's description of the property originally taxed was specified enough as to the items assessed is clearly support proof of omission. If an original assessment described property as 500 acres of land and the assessor later discovers that the property contains 600 acres, the assessor may make a supplemental assessment for the omitted 100 acres. How many assessors put the actual amount of acreage in the book? Trio, yeah.
And on the tax bill.
What?
It's on the tax bill,
Yeah,
but not the buildings.
Yeah.
Buildings aren't broken out.
buildings are not broken out, so. Land is a little bit easier, yet in a lot of cases, if it's undervalued or undertaxed, the town usually lets it slide until the next year when the committee comes out and sends the notice out. But it is legally permissible to supplement that difference if you describe the amount of acres in the book.
But this says it cannot be subject to a supplemental assessment.
You don't put acreage in the commitment book.
If an original assessment described the property as 500 acres of land, the assessor later discovers that the property contains 600, the assessor may make, doesn't say shall, it says may.
In this version, it says cannot.
You're down.
Oh, there, okay, I'm sorry.
Phew. Had me going for a second. These books have been rewritten a little bit, and I'm going, wait a minute. So 41 years, I'll just throw out the, if however the property was originally described as forest land and the value of 500 acres was included, the later discovery of 100 acres, additional acres, cannot be subject to the supplemental assessment. That's because it was only said forest land. It didn't say the number of acres. It's a slippery slope. I wouldn't go on either way. If you have an assessment, it's either an overassessment or an underassessment, and if it's an overassessment, they may be requesting an abatement.
Okay.
Underassessing something is a very slippery slope. If it's omitted, it's quite clear, but if it's a matter of fractional acres or something like that, don't bother. It's just like sending a tax bill out to a personal property value of $2,000 or so, $1,000 or something like that. It's gonna cost you more to discover, list, value, and assess than in mail than it's gonna return. No.
It's not worth the pain.
Yeah.
Usually it's not much, not to worry about.
The invalid avoid tax by reason of illegality, error, or irregularity. An assessment can be corrected by supplementing the person who owned the property for the year which it was erroneously taxed. Okay, an error in assessment would be supplemental, but you'd have to abate the person that didn't own it if you taxed the wrong owner. There are all kinds of situations that come up with supplementals. Yes. If you come across one in the future, that if you're not sure, network with a local assessor or call Maine Revenue Service and explain the situation, and they're more than happy, that's what we're here for, more than happy to discuss it through and give you life experiences. Our phone numbers are right on the website. under contact information. Okay, admitted tax, responsible parties. Who's responsible for making it? That's nothing. Oh, I even have a highlighted section. That must mean you need to use your highlighters. It's a couple paragraphs down from where I just was explaining. Supplemental taxes are valid even though they may result in raising more money than was authorized by the 5% overlay of tax provision 36,713. That means if you've committed your taxes and for some reason it was a very large property, we'll say, that was omitted. So the mill rate's going to be higher anyway, and you decide it needs to be supplemented because it was completely omitted. Supplementing that thing is going to exceed the 5% overlay that you're allowed by law. Doesn't matter, it's still a valid supplemental. You can't invalidate the supplemental because you've exceeded your overlay. Because it is a supplemental. You've already got your original commitment and the overlay there. This is a supplemental assessment. If I've got it highlighted, it's definitely got to be in your immediate future in some version. Interest collection. We won't get into the collection part. You're not the collector. The interest accrues. Well, you may be a collector now, I'm sorry, but in this class, you're not the collector. Abatements. Abatements is the process which, by assessed taxes that are determined to be excessive, may be reduced either in whole or part. Abatements may be made because errors in valuation by the assessor, because of overvaluation, ability to pay, or because they were simply uncollectible. Usually the collector will notify the municipal officials, being the selectmen, or if it's a full-time assessor, the assessor, after 2 years that this is uncollectible. Well, the business is closed, and why are we going to try to collect $25 off this mom and pop shop that had a business in town? So types of abatement. Error in valuation. Most of your abatement appeals are surrounding a dispute in the value of my property. That's an error in valuation. My property is only worth $70,000. You have it assessed for $100,000. Burden of proof is on the taxpayer. The only remedy available to the taxpayer who believes his or her property to be overvalued is an abatement request in writing to the assessor within 1 year from the committed date of 36/8/41. For commitments made after April 1st, 1992, I don't know why they kept that first paragraph in there, an abatement request must be made within 6 months or 185 days from the commitment of taxes. Failure to request valuation abatement within this time frame precludes further appeal procedures. Municipal officers have no authority to grant an abatement to correct an error in valuation. So an error in valuation cannot be corrected by municipal officials. The assessor, only in the capacity of the assessor, and they can be only granted for 1 year. It's the taxpayer's responsibility to know what they're being taxed for. An abatement request to correct a partially void assessment because of an exemption or a mistaken ownership may properly be included in this category of overvaluation and is subject to action for abatement. Okay, I'm going to skip down paragraph here. We don't have to get into manifestly wrong or ratios or anything else. Illegality, irregularity, or error. The assessor within 1 year from commitment or the municipal offices between 1 and 3 years from commitment may abate an assessment to correct an illegality, error, or irregularity. 36,841, the assessors, if the assessor properly requested a list of property under 36,706, we've gone through this, the declaration, the taxpayer must have complied with this request or be barred from appeal. Now, the key word in there is properly request. Did I properly notify you for that information? You simply can't bar somebody from an abatement because you mailed out taxpayers' returns in the center of the town report, the annual town meeting report. A lot of towns put a centerfold inside the town report, and here's your taxpayers' return. That is not proper notification.
Is mailing directly to the taxpayer proper notification, though?
It can be and it cannot be, but it's better, yes. In most cases, the IRS, Maine Revenue Service, everyone else mails any disputes or anything directly to you. They never call, so don't fall for the scam. They mail it directly to you. They don't send it certified. That's proper notice, according to the law. But there's a lot of confusion in appeals processes, and you want to save time if you've got a dispute and you've got a taxpayer that has been an issue or difficult in the past, you probably want to use certified mailing, especially for a personal property that has been but U.S. mail directly to the person of the corporation is proper notice. The IRS and Maine Revenue Service uses it all the time.
Real quick, off the top of your head, do you have some examples of things that would be assessment errors as opposed to valuation errors, aside from it going to the wrong owner?
Yeah, they were entitled to an exemption and didn't receive it. Yeah, 90% of the issues are valuation issues. Many rural towns, unfortunately, selectmen take valuation issues and turn it into error in assessments, which it is not. They have 1 year if they're disputing the valuation, but it happens all the time, and it even happens in further appellate hearings. I had a town have a tree growth penalty that went to not a penalty, a tree growth, wasn't even tree growth, but they went to the current use board, the State Board of Property Tax Review, over a portion of their assessment on their tree growth parcel. It was the value of the roads. The logging roads, they're not called tree growth roads, they're not growing trees, they're not prescribed as valued from the state tax assessor, they're not in current use. The state board said, we have the authority to hear that. I really disagree with that, because the other landowners that owned land that may have not been in tree growth and had roads were taxed similarly for those roads. That was their just value. But the state board, thought they had jurisdiction over that item. And they heard it. The taxpayer partially prevailed, but I disagree with that. It's part of the tree growth parcel, but it is not, it's like swampland. I said, their bog is assessed as all other bog at just value in town. I said, that is not current use land. If they change the use of that and decide to grow cranberries, I said, that's cranberry land. I mean, so, it's not tree growth land. It's not subject to a penalty if they change the use. If they decided to grow trees on the road and make it up, seed it, whatever, because the roads are pretty rudimentary in a lot of the cases, then they can, but these were well-maintained roads throughout the thing, guys.
So we assess by acre of road. Is that allowed?
Yes.
Yeah, okay, so we're doing that correctly. It's-
Yes.
yeah, okay.
And you probably are not getting any feedback, what?
We have
Excess land?
excess land too, but we also have in our card, road 1, road 2, gravel road, paved road. They're each at a different rate, but you have to have 1 acre of total pavement on the ground in order to classify for it.
It's a pretty skinny parcel.
Hmm?
It's a pretty skinny parcel.
No, these are inside the tree growth ones.
That's what I'm saying, the
yeah.
road is only 12 feet wide or something.
Right, but miles of roads.
Pick your battles.
Okay.
The roads are quite sophisticated.
Oh, the road's $1 million. Oh, yeah.
I think we're at $2,000 per acre of gravel road, or something like that.
That, you probably won't get much pushback on that.
Mhm.
Get up to 4, depending on the quality of the road, whether it's a class 1 or 2 road, which is open for discussion too. You may get some pushback.
Mhm.
Okay. The method of seeking abatement, current statutes require that applications for abatement be initiated by the taxpayer, be timely submitted within 185 days. Formerly, the court ruled that the application need not be in writing unless required by the assessor. It may be done in person. When applying for abatement of taxes, the burden of showing adequate reason for it is on the applicant, and he or she must prove or demonstrate enough justification to make a reasonable request for relief. Simply not, you can't go in there, my taxes are too high. We're talking about your valuation. The taxes are determined at the town meeting, sorry. Yeah. Notification of decision. Okay, we get into hardship, like. Excuse language. Okay, for hardship and poverty abatements, the municipal officers must provide the applicant with written notification within 30 days of their application. This is just for hardship, poverty, and infirmity. It's in the law, as I believe. The notification must include specific reasons for the decision and must inform the applicant of the right to appeal and the procedure for requesting an appeal. For other abatement requests, assessors must give applicants a written notice of their decision within 10 days after they take final action. The notice must state that the applicant has 60 days from the date that notice is received to appeal the decision, and also identify the board or agency designated by law to hear their appeal. You have to tell them what their rights are and what is the next step or level to go to, other than to get lost. You just can't say get lost anymore. If the assessor fails to give notice of his or her decision within 60 days from filing the application, the application is deemed to have been denied, and the applicant may appeal to the next tribunal unless he or she has agreed in writing to a further delay by the assessor.
So, does that mean that, like, if somebody applies for an abatement?
Yeah?
You know, things are busy or whatever, and you don't get to meet with the other assessors, say that it's a board of assessors.
Mhm.
How, it says first you have 10 days within the final action, so how long do
You
you
didn't
have?
take any action.
Right, so how long?
If
do
I
you
haven't
have-
heard from you in 60 days, I have to deem it as being denied, and I can, unless I've agreed in writing to an extension, I have to deem it denied, then I have my 60 days to go on to the next tribunal.
Okay, so we get an abatement request in 60 days, you know, on that 60th day, you know, that's when you get together to take your action.
Yeah.
Do you then notify them within 10 days?
Yeah.
That you've taken, you know, you've looked at
Yeah.
it or whatever? Okay.
Yeah.
And if you don't get a chance to look at it, then they can go on appeal?
Yes,
Okay.
because they've been ignored.
If you're getting there, I'd recommend sending them an email or a letter, you know, a couple weeks before that 60 days. You know,
Yeah.
rather than to say, hey, we actually had that happen last year. We were really busy. About 2 weeks before the 60 days was gonna be up, we sent the letters in, or actually did it via email. You know, we're trying to make sure that we put the right time into reviewing this and pulling the, you know, whatever supporting documentation we can. We need a little bit more time. We're gonna go ahead and extend the review of this till whatever. And when they wrote back, okay, that's fine with us, we're like, okay, we're good. So.
But what if they say, no, you had
I
60
don't know,
days?
do they have
Do they have
to
to-
agree to it, or
they
they just
have-
have to acknowledge that they received it? that they
We just
received
went
the
through this
notice?
with the county commissioners.
Yeah.
They have to
right-
agree to it, and they have to agree to it in writing.
Yes. Yeah. It's pretty specific, because in the real world, a lot of rural towns in Maine, the assessors go, that's not valid, and the taxpayer has to have some recourse. So, to be heard. And there's also the requirement, if you do deny it, you have to give them the reason why, and give them the opportunity to appeal it to the next tribunal, and you have to direct them which one it is. Because some taxpayers don't know whether you have a board of assessment, local board of assessment review, or they need to go to the county commissioners. Most of your commercial property over $1 million in value or more, no, they can go to the state board, because they've probably hired an attorney. Oh, did I shrink this up? Okay, the legal foundations, court cases, these are foundation cases. These are used by justices all the time. Some of these called foundation cases because they're the basis of the law. Instead of reinventing the wheel, judges will go back and look these things through. There's nothing on these in your test at all. Municipal appeals. Municipalities may establish boards of assessment review. The Board of Assessment Review is established by a town's legislative body at least 90 days before the annual meeting. The board is composed of 3 members and 2 alternates appointed by municipal officials. Towns ordinance by ordinance may provide the Board of Assessment Review to be comprised of 5 to 7 members and up to 3 alternates. That's actually in statute. Non-residential property exceeding $1 million may appeal to the State Board of Property Tax Review. This may be in your immediate future. In the index, there should be something about State Board of Property Tax Review. Someone wants to take a second and look for that while I'm looking for anything else pertinent here?
There it is,
Yeah.
did us, this morning, it is under the state code. 36,271.
Yeah. Okay, the State Board of Property Tax Review. The State Board of Property Tax Review is established by Title V, Section 12004, subsection or subparagraph 2, consists of 15 members appointed by the governor. The board has authority to hear and determine appeals from certain decisions of the local assessors, municipal officers, and local boards of review or the county commissioners. The board has jurisdiction over appeals from assessors' decisions on the property and tree growth tax law, farmland, and open space law programs. In primary assessing area, the board serves as the municipal officers in hearing appeals from the denial of an abatement for poverty and infirmity. Poverty and infirmity abatements are strictly confidential and have to be held that way. And if you do end up having an abatement, there should be a number on it. In many towns, I see I go in there, the taxpayer's name is right there. It's what poverty, infirmity, number 1, number 2, number 3, depends on, you know. No, there is no need to know because who the person, the party is. As I mentioned in the past, the State Board of Property Tax Review also hears municipal appeals that are aggrieved with their annual state valuation. Okay, appeals from the decisions of local boards of assessment review and State Board of Property Tax or county commissioners may be taken to Superior Court within the local jurisdiction, local county Superior Court. Appeals must be generally filed within 30 days after the decision. They only give you 30 days to act on this one. Okay, and then, or within 30 days after the application for abatement has been deemed denied. I don't believe there's anything on the test on that, and there's some court cases there. Special assessments, damaged school books, appliances, nuisance assessments, which is dangerous buildings, septic systems, street improvement assessments. There is nothing on the exam there. Sewer assessments, municipal development districts, similar to TIFs and all that, tax-based sharing. You'll need to be in a large community to even get into that. And nothing on the exam. Property tax relief, state revenue sharing, reimbursements for tax exemptions, tree growth tax law reimbursement. It won't have you calculating any of those. The state does that. Service charges, fairness credit, which is on the property tax relief fund. Mandate. That wraps that up. Is there any quick questions? Jim needs some time to go over something, right?
Income approach
Okay, you want to do it now or after lunch?
before lunch.
Before lunch.
Make
Okay.
sure you're wrapped up first.
Okay. Then right after lunch, we'll quickly go over the quiz. Did everyone take the quiz, the 28 questions, or start going through it, or? Okay. Later in review, I will review this whole manual, but I will only touch on very pertinent issues. And I will say, we don't need to discuss that today if the question comes up. Okay, for the sake of time? Yes, sir.
All right, we're gonna take a step back in time to chapter 6 in 103. Roughly page 113, income approach. So income approach being one of the three methods of valuing the property, cost approach being one, income approach, and market approach, I refer to as the direct sales comparison approach. As I mentioned earlier, the test itself does not have a tremendous amount of income approach on it. It's got one really difficult question. I would suggest a good guess is probably as good as anything else. We've been trying to fix that question for a while, and it's kind of like, it's the old Monty Python thing. What's your name? What's your favorite bird? And then how do you figure out the square root of whatever? So it's one of those kinds of questions. But I'm going to stay with the value equals income divided by rate. IRV is the backbone of all income valuation. There have been a couple people have tried to do band of investment and all this other kind of fancy stuff, and standing on the leg and rubbing on your tummy and all that kind of stuff. It really is just a rehash of the income approach. It deals with the principle of substitution. Would you rather have an income flow, or would you rather live in a building, as an example, and the principle of anticipation, which is a return of your investment and the return on your investment. Most important thing for tomorrow is an effective tax rate. You'll find it on page 115. And is the municipal tax rate, the effective tax rate is the municipal tax rate, $17.90, which is municipal tax rate, who I've been fighting with the town clerk for the last half hour.
I told you not to go there.
I had to. I just can't let it go. Just can't let it go. Multiplied by the town's declared ratio. So the effective tax rate is 2%. If the town's ratio is 90%, equals the effective tax rate. That will definitely be around tomorrow. If your town's at 100%, what's your effective tax rate? $17.90 in this example. Certified ratio. So does your tax rate and your certified ratio gives you your effective tax rate. As I mentioned, we're going to spend a ton of time on this. I think it's 3 questions, maybe 4, but I think it's 3. Recapture rate. If you're using on page 115 at the bottom, excuse me, recapture rate only applies to buildings. Recapture rate is your effective, as we mentioned in the depreciation portion of the market approach a couple days ago. Recapture rate is also your depreciation rate per year for the particular property. So if you have let's use the example here, if the property has a 25-year life and it is depreciated, and so it depreciates roughly 4% a year in a straight line method. That may not be true in the real world. It definitely is not true. Property does not usually depreciate much in the first 1 to 5 or 6 years, depending on the number of kids and the number of dogs. It could depreciate faster if a tree comes through the roof and they decide not to fix it, or they fix it inadequately. It may depreciate faster due to vacancy. All the properties that I have that come through that say it's a clerk certificate from the mortgager or the foreclosing company, whoever it might be, the attorney, somebody sent us something. All those properties go on my yearly punch list. I want to go drive by those properties or pull in the driveway and see if there's anything going on. If the property's starting to depreciate, my job is valuation. And if it's been vacant for 2 winters, the wallpaper's probably coming off inside, mostly due to moisture. After 3 years it's been sitting there vacant, I'm starting to get worried about the building. It's probably in big trouble. It's going to start rotting from the interior, and the only solution to that is a complete gut job to get rid of all the mold that's inside. It doesn't take much in Maine weather for us to have hot days and cold interiors in the spring, and warm interiors and cold nights in the fall, and the next thing you know, we've got a greenhouse effect going, and it becomes very, very, very problematic. So recapture rate, we definitely will see that tomorrow. So the amount of depreciation on your parcel, on your building. In this case, I've been looking at it the other way. This is the economic life of your parcel. We get to page 117. That's when you start doing capitalization, determining the cap rate. I will invite you to dig into this as you see fit in the next 24 hours, 12 hours. My suggestion is if you really have a handle on income approach, it's a problem that's going to take you a few minutes to do. All the data is there, including some extraneous stuff you don't need to. Like I said, I would have liked to have seen that. But if you can do the problem on page 121, it's worth 2 points. I'd rather work on the direct sales comparison approach for the next 26 minutes. I think it'll be much more beneficial to you. That entire page is highlighted. I'm not trying to blow it off, but put our resources where I think they ought to be. But if you can do an income approach, if you're in a big city, south of Augusta, you probably will do income approaches on a regular basis. Most of my properties that I have are single user, owner occupieds, or a multi-use apartment buildings is where I usually run into an income approach. And I will use a down and dirty income approach, IRV. If it sells for $200,000 and the income on the property, I've been able to ascertain, ask the property owners or the tenants what their interest is, what their monthly rent is. I can figure out what their rate is, and vice versa. Most of the time I'm doing something really down and dirty. I'm taking the sale price and I'm dividing it by the number of units, and I'm getting a rate, price per unit, and that's what I'm using for my towns. Town of Union has 48 units, 46 units in town. There's not a lot of units there. In Warren, I've got Bo's Mobile Home, and they've got a bunch of rentals. They're also, we're talking about one of the towns is a big buyer of woodlands. Bo's is the buyer of mobile homes and the seller of mobile homes in Warren, almost exclusively. They're the captured market, so when I get a sale on a property and they're the buyers, I do take that with a grain of salt. They're probably walked into it. They have cash deals, almost regardless of what the purchase price is. But I will take their purchase price, and I'll work out a price per unit sale price and go down, take a look at the unit, or the building, see if I can find out what the units are like, if they're in great shape, which they usually aren't. But that's another issue.
Would we usually be supplied with a cap rate in our questions on the test? We wouldn't be expected to come up with a cap rate.
Information is provided. Moving right forward. We did the sales ratio study number, which one? 7-1? Excuse me, 1A rather? Was that the one I mentioned the other day? You want to?
Could I ask you a question? Effective tax rate is what on that example?
It is 1611.
And the answer's gonna be in a percentage, the effective tax rate is a percentage when it goes into the bill. You're gonna have to move that a few decimals.
Oh.
0.01611.
One. Oh,
16%.
1.6% divided by 1790 divided by 1,000 divided by 0.9 would give you, yeah. Usually your effective tax rate when you're building in the cap rate is at a percentage. 1 point, it won't be 17 point, you're gonna have an awful high cap rate. So it's gotta be moved.
What's an effective tax rate? Effective tax rate is not.
Comes out at 1.611% is the effective tax rate. Percent, yeah.
The effective tax
Because if you put 1790 or 1611 into a cap rate formula to come up with the income approach, you're gonna have an awful high.
That's the correct math.
Yeah.
I was right. The answer, that is a tax rate, but just
We would take the actual mill rate.
actual mill rate.
Yeah, exactly.
There we go. Okay.
Okay.
Now I know where you're going with this.
Okay. Sorry.
No worries.
No worries.
Just wanted to get that one straightforward.
Yep.
Because if they're looking for 17 or 18% or 20%, they're not gonna see it in the answers, I don't think.
And, right, and think about just what's going on in the real world. We don't have 16% interest rates out there unless, there's some guy down at the corner with a mask.
Unless you got a mortgage in the early 1980s.
Right. And if you do, shame on you for not refinancing. But, the bank rate right now is 5.5. I don't really know, 5.25.
I think it's actually a little
I think it was a
lower
little
than that. It's
A
like
little lower, something like that, 5 anyway. Just that little bit of logic check is, if you come up with a cap rate of 16 and the market is really 5 on your own desk in your own office, probably you've made a mistake somewhere. If you've got that kind of cap rate, then I need to talk to you because I'd love to get 16%.
Is effective tax rate a cap rate?
Effective tax rate is not
It's
the
not-
cap.
Not the cap.
It goes into the cap rate, capitalization rate. It's part of
It's a
the,
piece of our
that's why I didn't
puzzle
want
to make it, yeah.
17.9 or 1611 in that, because the cap rate will be somewhere between 10 and 16 or 18 or someplace.
We want to end up close to
Yeah.
probably
Yeah.
the 16.
Yeah.
The total cap rate, depending on the, I'll stop there, because it's gonna
Yeah.
get very, very convoluted.
Exactly. Like I mentioned earlier, I went to Massachusetts and did income approach for a whole week. And driving back on the Mass Pike, I went, oh geez, I'm on the Mass Pike. Didn't realize where I was. But when you're figuring out on income and expenses on a property, you do not want to put in the taxes as an expense. You're looking to find what the taxes should be. So for your purposes, for assessing purposes, taxes, the previous year's taxes are not an expense on their P&L list. You want the income and expenses, but it's not part of what you're doing. You're gonna use that number when you get out to that final number, that's what you're going to use that to find what their taxes should be. Which one did we do? Is it 1A?
135.
What is it?
7.
7.2. And here's an answer sheet for 7.2. What a coincidence. Did you figure out how to do it?
I figured it out, I got it all right, I don't know if I remember how to do it now.
So we're gonna walk through it, we're gonna walk through this once, at least once. To find the weighted average ratio, what did you do?
We took the totals of all of the sales prices and the total of all of the assessed values.
And?
Divide your assessment by your sales price.
Yep. Total assessed values divided by the total of the sales price. It gave you a number. What was the number?
0.86.
What is it?
86.93.
86.93. Good number. It's a number. Weighted average. Average ratio.
87.
You had what?
87.
87. What'd you use?
Without the outliers.
Right.
Yeah. Total of the ratio of the mid 70% of the sample divided by the number of sales in the mid 70% of the sample.
I have a question about that, because when I did the math, I may have done this wrong, but in looking this up, it said too that you have to get to the nearest and then round up, always round up, so even if it came up to like.
But this one rounded down.
Yeah.
Yeah, I
Yes.
ran into that too.
Okay,
What do you
so
mean?
I'm not
Yeah.
The
on
rounded,
the
you
ballpark.
mentioned it the other day,
What rounded down?
the number of samples you use in the list.
Okay.
I don't know where this one exactly lands, but
Oh, those bold lines were supposed to
bold
be where it was
lines are-
doing it. I didn't even pay attention to the bold lines, and I
No.
did 3 and 3.
I paid attention to the bold lines because I saw that
Bold
they
lines.
had done that, but I wanted to question why they did that, because it came out to 4.5, which the next nearest
Would be
even
5,
number would be
yeah.
6, right?
Mhm.
Even number, because that's what they say.
yeah, I think I've not seen that.
So that
written
would be
anywhere.
taking 3 off the bottom and the top, so I just
Yeah.
thought I would ask that question.
I
And the-
took 2.
Yeah, in this case, that bold line was a clue.
Right,
Yeah. If it was 4.5, I'd take 2 and 2.
okay.
I don't know your theory.
It
No, it
was.
specifically said that
It did.
the example was
Yeah.
8.4 was the example,
Yeah.
and it says you always have to round up, so you would
So
round
the
to
nearest
9,
even
Next
number.
whole
but then
number.
it has to go to the next even
Next
number, so it
even
would be 10, and it took
It
5 off
says,
the bottom
it
and
says
top.
that in there?
It
Yeah.
does, it does
Okay,
say
plus-
that.
Right, yeah. And then we get to
130?
the example and they did not do it. Is that what you're saying?
Mhm.
Right,
Okay,
so I'm like,
good to
Yeah.
know.
I got
I'm
it all
like,
marked up.
that's why I put it down and said, question this, you
Yeah.
know, because it said it right
So,
out.
so let's, just for giggles, some of you did two up and 2 down, and some did 3 up and 3 down?
I went by the bold numbers.
Went by the bold, everybody else did it?
I did the 3, because I didn't
3
even
and
notice
3?
the bold, I thought that was part of us, is trying. that
What
we
we'll
were
do
supposed to
is
figure it out.
we'll put both up
Mm.
and just see how close it is. So-
It was super close. My rounding came to 0.86. It didn't round up to 0.87 on the weighted average.
Yeah.
Well, actually, that's not affected, that's all of them anyway, but I still got 87%.
Yeah.
I got
Weighted-
87.27,
Using
I did too.
2 and 2.
using, 2 and 2.
Yeah.
Yep.
And that was
Yes.
where I got confused, just to
I
round up or
got the
down.
same.
That's where I got.
I did the same. as you.
Because you use the ratio, you only use the first 11, and then the deviation, you use all of them.
960 divided by 11 is,
So let's stay with the 2 and 2, and I'm just use those bold lines as the guide. So, but if you did 3 and 3 and you did it correctly, you got the process perfect, and that is applicable. So I got no heart.
The answers all came out the same.
Yeah, it may have been, They may be, and we'll come back, they may be so close that. So the average ratio is total ratio of the mid 70% divided by the number of sales in the mid 70%, which came out to
960.
What did,
No.
Oh, sorry.
87.27 is what,
960 divided.
It's 960 divided by 11.
yes.
87%, 87.
87%. I'm gonna stick with decimals and decimals and percentages for a later slide.
Okay, sorry. This is when I'm gonna go back. It came out to be 87.27.
Correct.
Okay. I have no heartburn with either one,
Okay.
right? So the
Normally-
actual perfect rate,
Oh, you would round, well, oh,
we'll come to that, rounding theory, that's a good place to jump off. We'll come to that. So we'll use the exact one. Average deviation, how did you do it? Remember I was saying that up on one of these examples, they didn't have a column for depreciation in the example?
The average,
Deviation.
the average deviation, we actually use all of our sales ratios, not just the center 70%.
Right, it's not the,
And then and then the deviation
it's
is.
not, yeah, it's not the absolute value, right? Is it the absolute value of the deviation, or is it?
Absolute
It's the
value.
absolute
Yeah.
value of the deviation, but you use the average deviation is of all of them, not just the center
average
70%.
Right.
So
Yes.
you take the ratio, subtract from it the average ratio of the mid 70%. So in this example, you take ratio 62% minus 87. And you're gonna get a number down the left-hand side. Right-hand side. 82.
182.
So you then totaled all the deviations,
Mhm.
absolute value came up to what? 182 divided by 15, which came out to
12.2.
12.13.
12.13.
I got
See, I did
183
183 divided by 50.
Yeah, I did too.
Did you too? I did 183 divided by.
Get 183.
Yeah.
Yeah.
You told them all. Some of you are probably rounded.
Two.
So here's the clue. If you used 87.27, you probably have a slightly different number. Looking at the ratio expressed as 62,
Mhm.
on the first one, 62, 2 decimal points. So when you figure out the deviation, just use 2 decimal points. Round this one way or the other. Again, on the exam tomorrow, show your work. I know how to do this, I just rounded off here. Jeff will see, oh yeah, they knew how to do it, he knew how to do it. The process and procedure was correct, he just ended up with something that didn't quite match the testing number. No heartburn. So average ratio, 87. Weighted average,
It actually is 86.
what was it?
It's 86.
Okay. I believe you, I can,
Well,
I
it
got
could be
87.
different for me because, oh no, the rate is
I
what
got 86.93.
The answer says 86.
86.93. Weighted average, yeah, the answer said 86. Average deviation, 12.2-ish. 183 divided by quality rating. Quality rating is the average deviation divided by the average ratio. You have this somewhere, right?
Mhm. You gave us the-
That's about as boiled down as I can do it. It's okay. We'll talk about that too. We're gonna do another one after lunch. So we have the mean. It always asks you for the mean. So the mean in this example was 87. does this tell us? We see we got a weighted average of 86. The weighted average is just a number, it could be of interest, it could be something different. On the real world, I don't hold a lot of I don't hold a lot of weight in the weighted average. It's interesting. If it was significantly different from here, I might be concerned about what's in the sample, what should be tossed.
That's just kind of telling us our outliers was driving it down.
Yeah, maybe there's a wrong outlier. In this particular example, we get some 62s. So if you look at the deviation where it says on the answer sheet on page 188, the deviation is 25, 25, 13. The other one is 25, 21, 13. I can live with that. That tells me something. If number 15 said 45, I go, maybe that's not a good call. Even though it qualifies and it's all acceptable, and you've said, yeah, it's a good sale, I just happen to be off by 45. Maybe you want to take it out of your sample. Maybe it's not telling you. Maybe it's just everything's good, but it just doesn't work. Statistics are, it's kind of an accounting thing. Bookkeepers give you the right number, accountants ask you what number you want it to be. Kind of one of those things. If it's not quite fitting your circumstance, it's okay, take them out. As I mentioned earlier, I tend to leave more in because the town is eclectic sometimes, or maybe my time frame is not good enough. Maybe I need a 2-year or 3-year. The state's going to use a 1 year and then trend forward 6 months. So they're using at most an 18-month in most cases. In Friendship, they're doing 3 years, and we're struggling with that, even with 4. We've had good numbers, been right around 100%, but if you look at the quality rating, it's awful. It's 30-something. But that's a statistical problem. Just don't have enough properties, enough sales in the sample, sales in the sample to really help us out there. Quality rating is 14?
14.
Is that good?
Yes,
Yes,
under
because
20.
it falls
Under
to
20. If it's under 20, it's good. If I had 14 for the rest of my life, I would say, good to go. I'd be tickled with 14. But what it's talking about is what's the flares on your bell curve. You've got 7 on your side. That's pretty, I'd be pretty tickled with that. That would be good. I've had them as low as 8 or 9, right immediate post-revow. Didn't last very long. North Haven, when I was helping Tammy do North Haven, the best I could do was at 32 or 33. Most of the time it's right around 40. It's just
Why is that?
not enough sales in the sample. Just statistically.
And they were all in
Yeah.
different levels, or
Yeah.
comparing apples to oranges, basically?
I've got a $140,000 sale mixed in with a $2.8 million sale, and the ratios are just blown apart. And it's just, it is what it is. You can't reinvent it. So she always gets questioned on our quality rating, but there's nothing we can do. There's nothing.
Typically, your quality rating is a good kind of indicator of your overall quality or equity in the assessment
Exactly.
process.
Yeah. And, but it's a statistical marker, not,
Mhm.
walk out on the face of the earth of your town
Not
and
an
going, yeah, it's
actual-
good information.
Right, not actual.
They may,
fact.
yeah, it's all good information. So, statistically, you should have at least 30 data points in your sample.
So 30
According to my-
samples.
30 sales.
Right.
Is, or 30 any kind of data points. It's my statistics professor. You
And
need
this
30.
section said we have to have 12, right? Isn't there a requirement, or am I mixing up?
That's a
with
state
something else?
requirement.
State requirement is at least 12.
You have to have at least 12 to make it sample, but
Right.
yet the 30 would be ultimately what you choose.
Ultimately,
Is it-
what we choose.
12 including your outliers, so you drop one on each end, or?
Yeah, including
Okay.
outliers.
That's why this sample had 50.
See if I can. This was a paper written for demographic heterogeneity. Yeah, it has nothing to do with assessing. The use and misuse of coefficient of variation, Goldie rating, on organizational demography research. We're talking about how one person basically in an organization is going to screw up the whole deal. But, and this person, a characteristics of the variance or the standard deviation is that it is sensitive to the scale to which the variables are measured. Exactly what we're talking about. You don't have a good sample set. I was doing research on why deviations weren't very good sometimes. If you don't have a good sample set, you're going to end up with a bad quality rating. There's not much you can do. If you stick some tree growth in there, I include tree growth sales in my sales ratio studies, even though they're large acreages. If my acreages, large acreages are trending high or low, maybe I've undervalued some of that property, not the tree growth acreage. And what I'll do is I'll take that parcel, I'll convert all its acreage to a normal valuation, and I'll use that number as my assessed value against the sale price. And that will tell me something maybe. But I throw it in. Now I mark it green, tree growth, but I do throw it into the mix. I want to see how that might, might tell me that my rear acreage isn't high enough or is too low. You can really start, you can overanalyze this stuff a little bit.
So what you're describing there is generally what's going to be found on problem 7.4 with land and residential combined? Is that what you're
Right.
discussing? Okay.
Yeah.
So,
Or what we've got here is two classes of property.
right.
And you will be asked to separate out in one sample the two classes of property.
So you do separate them out first, totally, and, okay, because I'm trying to figure out what you were just describing in relation to this right here.
My tree growth sales are tree growth sales with buildings on them.
Okay, all right,
Yeah.
got it.
You know, just the raw land sales, I don't
Okay.
play with those at all. That's another kind of pain. Because I would throw those out doing a land valuation analysis anyway.
So this one here, you would almost break it into two separate charts, one for your
Mhm.
land and one for your residential.
Exactly right. Now, what would be different if you broke them apart?
Well, you could find out classes.
Classes, but your ratios are going to be different.
Right.
So that's what they're asking you to do, is just recognize, no. And the trap there is that, the total on 7.4, so the total on 7.4, the average ratio is 68. But, if you look at that ratio study, the class L,
Mhm.
looks like it shades toward the lower end of the valuation scale. So it might tell you that if you broke out your land might be at 55, but your residentials might be at 75, but they've been mixed here,
And you have to break it out.
and to break it out.
They would have us do that on the test.
Yep.
Yeah, so I'm expecting the 7.4 is much more like what we're going to see on the test than
Right.
any of the other problems.
It won't be as big and complicated as that, but it will be.
But you still have to separate out those values and do individualized.
This just says though to determine the weighted average, for the sales data below. It doesn't say if the residential sales or if the land sales below. Does it want both? Does it want one?
It'll tell you.
It doesn't break it out.
So it doesn't tell you that you want,
On
they want them all
7.4?
much.
Yeah, 7.4 is just residential and land. There's a little chart on the bottom right, but I believe the exam breaks out condos. It's an M and R thing.
Yeah, there's no actual condos or what.
In this particular sample, right?
So if it doesn't ask you to break it out, you
Don't
break
break it
lump them all together.
Yep.
Okay, so if it says take out the basically, barring the condos,
Yeah.
what would it be?
Right.
So you kind of go through and cross off all the condos and just
And
line
just
it
do the
up.
rest of it.
Okay,
Yep,
makes sense.
yep. Show your work in case that 2 versus 3 thing comes into play.
You know, that's the
I'm
one
kinda
thing I
concerned
didn't
about
turn
that.
in, when I took the test before, I didn't turn in, like, you know, because they give you scrap paper
Yeah,
with the
turn it
test.
in.
And I'm like, when I got, you know, I packed up,
Yeah.
of
Put
course,
it in.
by the end of the day, I was fried, but,
Yeah.
when I packed up, I'm like, I got home and I'm like, I didn't turn these in.
Yeah.
That's why you're here today.
So, yeah, really.
No, I don't think so, I don't think so.
Maybe you went into that.
So I'm not gonna tell you the sheet, but I'm not gonna tell you what you do in your lunch hour either. Okay? As long as you
Study.
come through the
You can
door,
study.
you can study. I did. I went back to the dorm, I did the law, I went back to the dorm at lunch, I came back down, and I had the land schedule in my head, and I wrote it down, and I had the sales ratio study formula in my head, and I wrote them all down. When I got to those sections, I reviewed it 15 minutes before, written them down when I walked through the room, walked through the door.
Write it
and
down on your scrap paper.
Write it down on your scrap paper, and then off you go. You brought it with you. That's the thing, you brought it with you up here. Just saying, you know, we're not here to trip people up, this is not, you know, thumb screws, and that kind of stuff.
Because in reality, you're gonna have access to those portals anyway, so.
Yep.
When you're assessing.
Yeah. When you're doing the law thing, the law portion, and it asks you for tree growth penalty, and there's a bulletin on your desk that might describe how to do a law penalty, or a tree growth penalty, sorta. There it is.
Work smarter, not harder.